And the reason we bring it up is because there's people out there talking about these, what I'll call abusive trust structures, where, hey, if you just put your entities into this complex trust structure, you don't need to pay any income tax.
My special guest today is Patrick Lonergan. He is a tax strategist with Vital Wealth. I have been on his podcast, and I'm pleased to have him on ours. And this is the Getting the Deal Done podcast. And welcome, Patrick.
John, thank you for having me. I'm excited for this conversation. I think this
Yeah.
is going to be a lot of fun.
So let's talk about what is a tax strategist. But before that, and I know you're going to give us some examples of what
Yeah.
you do and how you've helped clients. How did you get to be where you are now? What's the Cliff Note version of the journey?
Yeah. So I've been an entrepreneur for 20 years. And before I got into, I'll say, being a tax strategist, I was a real estate entrepreneur. We held some real estate, we flipped some real estate. But one of the things that I was always frustrated by was the lack of proactive planning on the tax side of the equation. And so um, in 2008, 9, 10, the real estate market melted down. It was my job to go find the deal, raise the money for the deal. And there wasn't many deals to be had. And so I had some friends in I'll say the financial advisory consulting space. And I started talking to them, and uh, the opportunity seemed like it was interesting to really get into the space and go, okay, let's be proactive on the tax planning side, because CPAs are fantastic, but I think people get confused on their role. Their job is to file a compliant tax return with the IRS. And so it's just memorialize all of the information. And their business model just isn't designed to be plugged into the entrepreneur's life like we can be. So in 2010, we started working on let's serve the entrepreneur in a way that the marketplace really isn't, and that looks like tax strategy, and that combines with cash flow and we'll say investments and legal structures as well. But really, tax strategy drives all of that. And then I'd say over the last 15 years, I've had a number of mentors, a number of clients, advisors that we've all just gleaned different pieces of knowledge and wisdom from those folks, and really created a framework that helps the entrepreneur save a tremendous amount of money. Our average client saves $280,000 of income tax, and so most people come to us because they've had two or three CPAs, all thinking they were going to fix the tax bill, and that's sort of the short summary of how we got into the mix.
Yeah. So you will work with the business owner, client, and their CPA to tr try to
Yep.
get these things implemented.
Yes, absolutely. And I think that it really makes a three-legged stool that makes a lot of sense. So we understand the client's goals and outcomes. We meet with most of our clients, unless they've sort of settled into a nice rhythm where we're not adding anything new. We meet with them every month. And so we understand the cash flow of the business. We understand in July, we're forecasting the tax liability. And so we're creating the strategy that aligns with the client's goals. And the CPA, we're not trying to replace the CPA, but the CPA still has to sign that tax return. And if the IRS comes and audits that return and it's got problems in it, the CPA is financially liable. So they have a vested interest in protecting themselves and you from some strategy that's could go haywire. And we'll talk about some of those strategies eventually. But that's how we think the client's really protected and gets the best outcomes, is having that three-legged stool.
Okay. So we talked about tax strategies, and I think we have, you obviously we all have income tax before, and owner has it before they exit, and then it's
Mhm.
part of exit planning, and then it's what are the capital gains taxes and ways to mitigate those. So let's start with you've got a client, they're a business owner,
Mhm.
and they they're not at the point where they want to think about exiting yet. But of
Yep.
course, if you do the things you're supposed to do to exit properly, you're better off along the way anyway. So
Right. Yeah.
So let's talk about that, the income
Yeah.
tax
This
deduction
is
before I
fantastic.
get in.
So we have four levels of tax planning, and we'll just start at level one. That's where everybody starts. And level one is the IRS gives us guidance, but it doesn't take any investment. So this is good administration and bookkeeping. And we think there's almost two categories of level one planning. There's the things you can do on your own, and then there's some that need some, I'll call it professional guidance to make sure that all gets executed well. So some examples of level one tax strategy are we'll call it we'll go the lowest hanging fruit and the lowest deduction to the some higher opportunities. But the first one is, especially for our entrepreneurs that are doing well, is the home office deduction. The IRS will give us a standard deduction of $1,500, or we can itemize all of our business expenses or all of our home expenses, and then we can take our square footage of our home office and divide it by the square footage of our house, and then we take all those expenses, and that number usually is a $3,000 or $4,000 figure versus 1,500. And I'd rather get those extra dollars. It might take me, I don't know, an hour, probably less, to get all of those expenses for my home sort of put together, and that's just maybe a free $1,500 of tax savings that I wasn't getting before. So we like that. Another opportunity is what's called the Augusta rule. The Augusta rule was named after the golf course in Augusta, Georgia, where the Masters is held, and people were renting out their houses to um, tour pros, the PGA Tour, media celebrities that are there to cover the golf tournament, and they could take that income for 14 days, up to 14 days, and not have to claim it as income. And so I'm not asking any of our clients to go rent their house out to some random stranger, but what I can do is I can have business meetings at my house. I can have employee appreciation meetings. I can have vendors, contractors, advisors over. And if I do that 14 days throughout the year, I can go on a site like Airbnb or Peerspace and see what my house would rent out for the day. And I can use that comparable um, to give me an opportunity to create a deduction on the business side. Let's say it's $1,000 a day, okay, that I can rent my house out for. There's a $14,000 deduction if I use all 14 days that I get to write off from the business, but I don't have to claim as income for myself personally. So I get to move money from my right pocket to my left pocket, and it's tax free. And we like those types of opportunities. And then the last one that a lot of our clients utilize is family on payroll. I have three daughters. They're 15, or excuse me, 17, 15, and 12. And they do work here. My one daughter pays some bills for me. The other two clean the office space. And so we can pay them $15,000 a year, which is a standard deduction amount, and they don't have to pay any income tax on that. So my kids are driving around vehicles, putting gas in those. And so I pay them to do legitimate work. I've got a job description, but I move it from the top tax bracket down into the 0% tax bracket and have, um, my kids that are going to spend money on things anyway. Now they're buying their own school clothes, they're paying for camps. All of those things are coming out of those accounts. And it's just, again, moving money from my right pocket to my left and getting a tax deduction for it. So there is some nuance with that. You do have to file um, a W-2 for the kids. And so we've got a whole free handout that people could have to just understand those pieces. But those are good level one strategies there.
Okay. So what's level two?
Yeah, level two is the IRS gives us guidance, but we have to invest dollars. So, most common example that people think of are IRAs, 401ks. But there's some opportunities here that people maybe aren't aware of, like a cash balance plan. We've had clients get three, four, $500,000 into a cash balance plan, which is effectively a pension plan, and it's based on a calculation of your age and your wage. And the older you are, and the more money you make, up to some limits, the more dollars you can get into one of these strategies. But oftentimes we'll have a client and get their spouse on payroll, and we can get a tremendous amount of money, sort of tax deferred, that we don't have to pay tax on now, and we can draw out later when we're maybe after we've exited the business and we've got a lower income. draw that out in a lower tax bracket. So there's lots of opportunities for level two strategies, even some what we'll call oil and gas investments, where the IRS gives us some really interesting opportunities with depletion and depreciation to get about 80 to 95% deduction for the investments that go in there that can offset some ordinary income. So we like to take advantage of those. They're very low cost to implement. They're our CPA has absolutely no issue with these because it's very clear on the IRS code what we can do with those. But we think that that is a good opportunity, and we always like to start off with as many level one opportunities as we can, and then we move up to level two, and then we'll move on to level three investments. Some people will come to us and say, "Hey, I heard about this really fancy tax strategy," and it's like, well, we could do that, and it's probably a level three strategy, and we'll define what that is in a minute. But it's like you haven't done all the level one and level two things, which are easier, lower cost to implement. So,
Okay.
um,
So,
yep, those are the
let
first
me,
two
I want
levels.
to ask you something, Patrick, don't, before I forget to ask, the cash balance plan you talked about, is that like a defined benefit pension plan?
Yes, it's exactly the same thing. So, and when we think about defined benefit versus a defined contribution, a 401k and IRA are defined contribution. It's the amount of money is defined that I put in, and then a defined benefit is, and that's where the age and wage come in. Depending on how old I am, there's a calculation on the benefit that I need to have when I get to retirement, and so those are calculated in the based on my age and my wage. So
Right.
we can, yep,
Okay.
very
So
good.
level three.
Yes, level three is we are combining sections of the tax code to create tax efficiency. And uh, almost always we have a third party administrator that is good at that particular arena execute on these. And the reason being is this is where abuse can take place. And the IRS will come and look closely at these strategies. So you want somebody that's been down that road before, that understands what the strategy is, how to execute on it well without having any issues. And I'm going to give you an example here. An example of a level three strategy is what's called a captive insurance company. And so when we think about our insurance premiums that we pay for everything from our property casualty to our E&O, those are all tax deductible expenses. Now, on the insurance company side of things, there's potential claims there. And so those premiums are not taxable. And so when we think about that, it's like, okay, if I own the insurance company, now it's a separate entity that I have to set up. Typically, we're looking at doing those in the state of North Carolina. And they're managed by the state insurance um, commissioner. So it's not like it's just I decided to set up an insurance company and that's all I had to do is create an entity. And now, so what I've got is I pay the premiums into my insurance company. For it to be a legitimate insurance company, it has to be pooled claims. I have to have third party. So I have other businesses involved in my insurance company. So that's where the third party administrator comes in that does this. They might have thousands of other businesses that they're pooling together to spread out the risk here. Third parties are pricing that insurance, so it's not me just going, "Hey, I'd like to put this much money into this strategy," and so we identify the areas we want covered. Typically, they are low probability, high impact um, coverages. So, loss of key employee, loss of key client, cyber threat over and above, like what maybe my current cyber coverage has. If I'm running a trucking company and I have $100,000 deductibles, it can sort of sit in the gap here and help me cover that deductible if I need to. So there's lots of different ways that we can add coverage into the mix. And one of the nice things about that is it's creating legitimate insurance, but it's also creating me a pool of these tax-free dollars that I can invest. And I can invest it in a traditional stock and bond allocation for some point in the future when I have claims, or I can, once those I get a few years down the road, I can loan those dollars out to an uninsured entity. And here's an example of that. My wife and I own quite a bit of real estate, and we've had Prudential be one of our lenders in the past. So Prudential's an insurance company. So they have these dollars sitting there in reserve that they need to invest in some way, shape, or form. So making loans against real estate is a good way to do that. So if I decide I want to go in my business acquire a piece of property to run my business out of, I can create a new entity for that that isn't insured by the insurance company. They can make a loan to that entity and it can go acquire the property. So I'm effectively using pre-tax dollars to go um, make that acquisition. And I like that. And if we're going to sort of double dip on the tax opportunity with real estate, I get things like with the big beautiful bill that recently was passed. I get 100% accelerated depreciation on anything that's 15-year or less. So I can do a cost segregation study and might be able to get some additional tax benefit out of that acquisition. So I'm almost double dipping on those dollars that I got from the captive insurance uh, investment, and then reinvestment in that loan where I bought the real estate. So that's an example of a level three. But again, if you Google captive insurance, you're going to find that it's on the IRS 30 dozen list. Okay. Now that just means the IRS is going to look very closely at it. And so you have to have somebody that knows what they're doing. We've had clients come to us that have a captive in place that was set up offshore, that is run by a guy that's literally in prison right now because of shady activity. And it's like, okay, that is not the type of third party administrator you want involved in your life, because your life will get awfully uncomfortable. So we want to find somebody, and we've got a number of captive administrators that do a great job of administering these things, administering the claims, setting up the pool, all of those pieces. And so, and that's just one example. There's a number of what we'll call level three strategies that are out there.
Okay.
So
So let's move on to tying these strategies into when someone is starting to think about exiting.
yeah, that's good. Can I touch real quickly on a level four strategy?
Sure.
Okay, so level four is tax fraud or tax evasion. And the reason we bring it up is because there's people out there talking about these, what I'll call abusive trust structures, where, hey, if you just put your entities into this complex trust structure, you don't need to pay any income tax. Or if you spin up a faith-based organization and put your business into that, you don't have to pay any tax. At the end of the day, that's going to get you put in jail with Wesley Snipes for tax evasion, and you don't want that. There's plenty of opportunities to minimize the tax bill, and we can even go back to a level one strategy where I put my kids on payroll. If I put my kids on payroll and they're not actually doing any work, that's tax fraud. I shouldn't do it. I should stay away from it. So I like to just highlight some of those opportunities out there as well. Just because you read it on the internet doesn't mean it's a legit strategy. So we like to be mindful of those and stay away from things that are going to get us in trouble. So, yes, so let's move on to looking at opportunities to minimize the capital gains tax. We've been talking a lot about income tax. Let's talk about the capital gains tax. There's really three main types of income that we get taxed on. There's our earned income, which we were just talking about. There's investment income, which is the capital gain side. And then there's like a passive income if I'm an investor in like a limited partnership or something along those lines. So it's nice to understand these different buckets because I can't use the strategies for earned income to offset investment income. So there's a different set of opportunities there. So if we look at the capital gains side of the equation, we really have what I'll call four different opportunities for reducing the capital gains tax. And the longer we have to plan for this, the better. So we've had clients that have called us and said, hey, I sold my business January 1st. let's call it February when they call us. I'm going to have to pay some tax this year. What do I do about that? It's like, well, there are some opportunities because we still have some time left in the year. But in general, if you close on December 31st and haven't done any planning leading up to that, it's going to be really challenging to create some opportunity. So the longer runway we have, the better. But here's the four opportunities we have for capital gains tax. First is deferral. I can defer the tax down the road. The second opportunity is reduction. I can reduce the tax that I have to pay. Third is philanthropic. If I'm charitably inclined, there's some fantastic opportunities out there to be charitable and also really drive the tax bill down. And then the fourth one is what I'll call location. I can relocate to a lower tax jurisdiction, and that's probably my least favorite. And we'll get into why that's the case, but yeah, those are the four opportunities we have. Um, is it? Can I start talking about some of those, or do you have questions about any of those
No,
before we
let's
get?
talk about let's just go into them and talk. First of all, talk about I think you talked about deferring.
Yeah, yeah. So deferral. Deferral doesn't mean the tax goes away. It just can move down the road. Okay. So what the thought process is here is we want to utilize all of the sale proceeds for as long as we possibly can. And so if I think about that for just a second, I'm going to sort of create an example for understanding the impact of this. So if I sell my business for $10 million, we'll keep the math simple, and I pay 20% capital gains tax. And we're not going to assume any state income tax or capital gains tax here. So I go from 10 million, I pay 20%. My cost basis was zero. I end up with $8 million of proceeds. If I go invest those $8 million at 7%, I have $560,000 of annual income. Very healthy income. I like that. But if we think back and I take $10 million and I'm able to defer that tax and I invest all 10 million, now I have 7% investment just like I did previously. Now I have $700,000 of income. So that gives me 25% more income. The 560 to 700,000, and over 10 years, that's $1.4 million of additional like economic value that I've created by just using a deferral strategy. So let's look at the opportunities here. The deferral strategy really revolves around what I'm going to call an installment sale, and that's code section 453 for any nerds out there. Don't want to dig into it. So an installment sale just says I don't have to pay the tax until I recognize the income from that sale. Now, there's a number of different opportunities to put together for this. The most traditional one is I seller finance. The problem with seller financing is now I'm taking on all the risk of this transaction going well with that buyer
Yeah.
performing. Well, I don't like that. I don't like taking on the risk with the buyer, could run my business into the ground. So, how do we offset some of that? Um, let's see. This doesn't necessarily offset it, but it's a way to get your cash up front and still get tax deferral, which is interesting. And it's called the monetized installment sale. So that note that I've created when I sell that has economic value. I can go borrow money against that. When the payments come in, they effectively pay my note, and I got a lump sum up front. So that's a monetized installment sale. Next is a structured sale. This would be we've got to get an attorney involved, but it's effectively all the cash proceeds then go to I'll say a highly rated annuity company, and they then send you payments, and the default goes down dramatically, almost to zero. With we got the annuity company, AAA rated. We have the state insurance pool backing up that annuity, so it really eliminates a lot of the risk, and you get some nice tax benefits there. But this one might be my favorite opportunity is what's called the deferred sales trust. So a cash buyer comes in. We decide we don't want to recognize all of the income right away. The deferred sales trust gets in the middle of this, and all of the sales proceeds go into the deferred sales trust. So it's cash sale. We don't have to worry about default. But then the trust meters out proceeds to me on a schedule that I choose. So I can defer the proceeds for as long as I want, actually. I could defer those to my children. If my children keep this trust going, there's a way to really push that
Yeah.
tax down the road. So that's probably there's a lot of nuance that goes into the deferred sales trust, but it's a unique opportunity, and we're going to come back to that one in just a minute because we're going to combine some of these together to show how to wipe out the capital gains tax altogether. So those are, I'll say, some deferral strategies using the installment sale. Next is qualified opportunity zone. We really got some new benefit from this with the big beautiful bill. They've changed some of the opportunity there, and so it will move the tax down the road. I get 180 days after I sell my business to invest the dollars, and then it'll move the tax down the road. Year five, I have to pay the tax. Now I can get a step up in basis in year five of up to 30% if I invested in a rural opportunity zone, which is really nice. And then there's also continuing down the road the um, opportunity zone will allow me to defer all of my investment gains in that opportunity zone as well. So there's some unique opportunities with that.
And opportunity zones are a real estate development
Yep.
project in certain designated areas. You're not going to put it in a major metropolitan area that's thriving, right?
Correct. And there's so the rules changed. There were areas that so each state got to identify where they wanted to have the opportunity zone, and there was I'll say a loose set of rules around um, where those could be placed. So some states had them in areas that weren't so bad. Now they've gotten much more specific on the I'll say the economic criteria for that to work for this time around. But one of the interesting opportunities is we have some clients that really like oil and gas. Well, the Permian Basin in West Texas met all of the economic criteria for being an opportunity zone. And so you could invest in oil and gas investments in an opportunity zone. And it was a pretty neat opportunity. You didn't have to go invest in low income housing, for example. So there are a number of different opportunities there to invest in the opportunity zone, but you have to really like the investment and be committed to it for a long term. So probably not my favorite strategy, but it's one I think we should at least talk about. And then
Okay.
the last opportunity for deferral is a private annuity. And this has so many strings attached. I think somebody should really pay close attention, but I can set up my own annuity. Okay. Um, it's annuity is a tax wrapper. Okay. And when I draw the dollars out, I get taxed at ordinary income. So the thing that really makes me nervous is I can create this structure that will move the tax down the road, but I moved from a capital gains structure at 20%. All the capital gains rates are lower than the income tax rates to an income tax rate on all of my gains. So again, be very, very wary and have a good strategy for fixing this problem. But I can create a private annuity, move my business into the annuity, sell my business. Okay. Now all the proceeds are in the annuity, and I can decide when to draw those out. I can distribute those or I can annuitize it. But again, it's taxed at ordinary income. And if I push this down the road when my heirs receive the annuity, they've got a limited window to get the dollars out. So I can really create a tax bomb for some point in the future using that strategy. But it is one that's out there, and we feel like it's worth a mention. So,
Yeah, it's very similar to when people use what's called the ROBS program and have a 401k, their
yep,
401k invest in their own business, but
yep,
the end they're going to, they can sell the business. It goes into their 401k to roll over tax deferred until they pulled out, but it is ordinary income. So,
yeah,
okay.
yeah,
Hey, this is very fascinating, Patrick. I mean, this is uh, obviously you can't educate people on the whole thing in half an hour,
right,
but
right,
you're planting seeds and ideas. So,
yep, yeah.
tell me, tell the audience a little bit what do you like to do besides tax strategies in life?
Yeah, yeah, that's great. I think about my hobbies and things I enjoy most. I think it starts off with my faith's awfully important to me. I spend some time studying the scriptures, journaling on a regular basis. I also have, like I mentioned, three daughters. I married my high school sweetheart. I tell people the trick to finding somebody way out of your league, and I've married somebody that's way out of my league, is get them to fall in love with you when they're 17. They don't know any better. So that's my trick there. I spent a lot of time. I coached some of my oldest daughter is a good high jumper. We just got back from the national meet in June out in Eugene, Oregon. Have a lot of fun spending time with her on that. My other daughter was just at the national wrestling tournament. She's a good wrestler. Iowa has women's wrestling in high school, and so she's doing well there. And the youngest one, she's very creative. She uh, designed some shoes for me. I bought some white shoes and she dyed them a certain way, and they turned out fantastic. So
Uh,
love spending time with my girls, and then I like fitness, nutrition, sort of being a nerd, not just on the tax side, but just making sure my body's in good shape as well. So those are my hobbies and things that I enjoy doing. So
yeah, I mean, it is important to have stuff outside
yeah,
of business, especially when you get into the weeds like you do on tax strategies, which can
yeah,
fry a lot of brains, maybe not
yeah,
yours, but it can fry brains.
yeah, yep, for sure, for sure.
So thank you for being here. This is Patrick Lonergan. He is with Vital Wealth, and you can reach him at Vital Wealth, Vital Wealth.com.
Yeah.
Is there any other way to reach you?
No, I think that's great. And if you search for Vital Strategies podcasts, we're out there, and you can go listen to the episode that we were on. We're just really diving into all these tax opportunities and ways for entrepreneurs to grow their business and scale. And what we'll say is live a full life. At the end of the day, who cares how many dollars you have if you're not enjoying it here on Earth? So we think those things are important as well.
Well, thank you. And again, thanks to everyone who's watching and listening on this when it comes out. So appreciate it, Patrick.
Yeah, thanks, John.
All right. Bye.